Here we go, 3.4. We're expecting 3.5. 3.4 is the number on consumption. 3.5, that's actually a wee bit light, so we're a 10th light so far. 3.4 headline, 3.5 consumption. Price expenditure, 10th heavy here, 1.8%. Rear view mirror was 1.7, matching expectations as well. Quarter over quarter, 1.6 on PCE core. Now let's go to durable goods. Durable goods up 0.8, up 0.8. This is preliminary. It is actually half of expectations, unfortunately, but it's a whole lot better than our last look, which was down 4.3. If you take transportation away, it really goes down, minus 0.3, so that's a miss. Minus 0.6 on capital goods orders, non-defense aircraft, a proxy for capital spending, so that's a disappointment. And finally, if we look at shipments versus durables, that is down 0.6. Excuse me, that is down 0.1. Shipments, the orders was down 0.6. So none of these are good. Now, there are positive revisions. Some think that latter series is the most important. When it comes to orders, last look was unchanged. That ramped up to 0.5%. That's a nice jump. And on shipments, we ramped up from 0.3 to 0.8, so also 0.5%. So when you factor those in, the misses then become much smaller on an averaging process. Not a lot of movement on the fixed income side. We're still hovering just above 2 3/4 at 278 for a 10-year note. And the Dow futures did trim some of their losses. I'm not looking at fair value here, just looking at the raw futures data. Joe, back to you.
All right, thanks, Rick. And Steve Liesman joins us now with more 123. We ticked up a little bit. Is that durable good?
Yeah, I mean, these are sort of good. But let me just point out they're a mess. Reporting on these numbers, from as far back as I can remember, which is like 2 decades, they are always a mess. You're lucky 1 month to the next to get them on the same side of the zero line. But it's a big story. And the reason it's a big story is because we all want to know what's happening with capital spending in the wake of the tax cuts. If you look at the Fed's description of the economy, the one thing they say has been moderating has been business spending. The administration, Kevin Hassett was out yesterday with a big chart, which I maybe should have up, maybe I'll have to do it next week, showing that over the course of the period of the tax cut, business spending is way up. The problem is that the last several months it's been down.
I think that's the old story. Whether we're looking for any data point about the economy, aren't we? All of a
we're
sudden,
holding on by our pinky about a 20-story building here.
Aren't we happy durable goods are at least positive?
Yeah. So I think the numbers, if I'm not mistaken, I'll get an email from my econ buddies in a minute. We'll flatter fourth quarter GDP depending upon what was built in, because of the upgrade and the 0.8, which feeds into GDP on the new orders, on the shipments of new orders for business spending, manufacturing goods business spending. So we're not I think the bottom line, and I think Powell has said this, and even Mohamed is saying this, we're not falling off a cliff, and it's really hard to go. It's not a Porsche in reverse. You go to 60 to 0. Right? That's what it seems like the market is pricing in. And we talked about this yesterday, and I'm interested in Mohamed's thoughts on this. I don't think the Fed's doing a very good job of two things: guiding the market and convincing the market, right? They have an attitude out there, which is that we're going to slow but not stop. And they also have an attitude which is that the right policy action in this context is to hike rates. And the market has basically given a series of, what's the right word? Sort of Italian insults that you can't say on television in any language at all to the Fed, right?
So the way I think of this, Steve, is that the market is reacting to the realization that they no longer have the support of central banks. Let's not forget that the ECB is stopping, even though the economy there is in a bigger mess, much bigger mess. So the first thing is the market is realizing that without ample and predictable liquidity, it's a different volatility regime, it's a different valuation regime. In terms of the Fed, I wouldn't have done anything different in terms of action, but I would have communicated differently.
How?
Two things, and I said it earlier.
Chairman Mohamed, take the floor.
So, two things. One is I would have said we're very sensitive to what's happening outside the world. because we worry about spillbacks.
He didn't feel the market's pain enough.
And then the second thing is you cannot confirm that QT, that balance sheet, is on complete automatic pilot when the global economy is strained. I would have said...
Can I point out that...
Hold on. I would have said nothing is off the table. Because if you don't, you put so much burden on the interest rate tool that whatever you signal on interest rates gets amplified tremendously. And then you get bad...
I'm so proud of what I did in September 2017 that I want to run it again. I don't have the tape.
What's that?
I raised my hand when they announced this policy, and I said, Madam Chair, to Janet Yellen, are you telling me that if the economy turns down, if there's a big change in the stock market, that you guys are not going to change your balance sheet policy? And I envisioned this exact scenario because I was a little incredulous when they announced it, and she said, no, we're not. We've asked Powell that, not me, but other people. Heather Long, I guess, from the Post the other day did it. Said, are you telling me? And they said no. The reason why they're not changing it, to me, is the opposite of what it should be. They say they're not changing it because they're not that familiar with the effects of the balance sheet reduction on the market. That should be a reason to change it rather than not change it.